The Australian Financial Review.
Hello, I'm James Thompson, Senior Chanticleer columnist at the AFR. Welcome to our weekly news breakdown of all things business, finance and markets. With me today, as always, is my Chanticleer colleague. He's always in pole position in the Grand Prix of life. It's Anthony McDonald. How are you, Anthony?
Revved up and raring to go, James.
Fantastic. Well, this week we break down an incredible week on markets. We explain how the super sector became the poster child for bad corporate governance. And we take you inside the Formula One money machine. But first, Anthony, you've been all over this incredible fight for survival at casino operator Star Entertainment Group. Now, this company's been seemingly on the brink of collapse for weeks, but on Friday night last week, it seemed that the company had been rescued with a very complicated deal involving the sale of some casinos and an apparent funding round. But then on Monday morning, another takeover bid lobbed from a mysterious US group. Anthony, I'm a little confused. Is the Star actually out of the woods?
I wish I could tell you it was, James. But, bear with us, listeners. You're generous by saying this thing's been going broke for weeks. In my mind, it's like 2 years.
Probably.
It's been coming. But what's happening now is actually very significant. So like you said, James, on Friday night, Star, in its words, or words of the people around it, pulled a rabbit out of the hat, right? It pulled off a three-headed monster of a deal aimed at getting its short-term money that it needs to pay its employees, suppliers.
Yep.
It was aimed at sort of stopping the bleeding at this Queen's Wharf, this giant new casino it has up in Brisbane, and refinancing its debt stack just to put it on a more surer sort of footing for the next few years. So, James, it was nifty deal-making. There was a lot going on. Everyone had written it off, thought it was going to go into administration, that CEO Steve McCann wouldn't be able to pull this off. And he has. Yeah. But all these deals are subject to a bunch of consents, approvals, due diligence, confirmations, all that sort of stuff.
Right.
So until all those agreements are signed, I think it's better off not calling Star saved just yet. So, James, once we get through the conditions, Star will be safe. But like you said, it got all funky on Monday morning when this US casinos group, Bally's Corporation, lobbed a refinancing proposal that was kind of like a takeover offer. Basically, it wants to come in and own at least half of Star's shares and basically run the company. So late on Friday, Star agrees to all these refinancing deals. And then on Monday, a whole new thing gets thrown in, this Bally's offer that could potentially change everything.
Yeah, so just tell us a little bit about this Bally mob, because they're run by a fascinating guy, a casino entrepreneur called Soo Kim, and he sort of specialises in going around the world, picking up busted, broken casinos and trying to fix them. Like, it's an extraordinary model, but sort of seems perfect for Star.
Yeah, Soo Kim's an opportunist, James. He's actually a hedge fund manager from New York. And his hedge fund took a big stake in this casinos group and rolled it into another one. And basically now they're just going around snapping up casinos left, right and centre. And they typically target the ones that other people won't touch. So they've now got 19 of them. Star's the latest thing that other people are reluctant to touch. So he's been here in Australia checking out Star's casinos in the past couple of weeks. But he was actually, I think, waiting for Star to go bust. He thought his best chance of owning Star would be picking it or some of its casinos out of administration, which, because of this deal on Friday night, it's not going bust, or at least not yet. So he played his hand on Monday morning. Star's given it short shrift a bit. It's considering it, going back to him, seeking a bit more information, all that sort of stuff. But really, the main game for it is locking in that refinancing.
Yeah. Anthony, I spoke to the CEO of Crown Resorts late last week. He appeared at a conference on Tuesday where he sort of made a pitch for a bit of regulatory fairness. His point was that the casino sector's been through this regulatory firestorm. It's had all these conditions imposed on it. There's limits on the amount of cash you can use. There's limits on the amount of money you can lose in any one trip to the casino. But down the road are pubs and clubs full of pokies that have none of these restrictions. And he's sort of like, well, how is the playing field level here? I get the logic behind that, Anthony, but I can't see politicians running out to impose new restrictions on pubs and clubs. So does Star and Crown just have to deal with this bigger problem, regardless of whether they can get out of the financial muck?
Definitely, James. They have to realise, look, the game's changed for them, and they can call on the politicians to crack down on the pubs and clubs, and probably in time it goes that way. But for now, they've got to keep their heads down. They've got to do what's asked of them of the regulators and make their business a bit more future-proof, focus on all the stuff that's not gaming, and then work out how to keep getting customers in the door when you've got $1,000 cash limits like they're going to have in Sydney later this year. When you've got carded gaming, you've got things like mandatory breaks. I mean, that's all part of life. It's hard to see that getting scaled back, so they've just got to get on with it.
Yeah, well, let's see where the Star saga goes. Probably still some water to go under the bridge.
James, we love bad boys in corporate Australia, and we've just been talking about one in Star. But this week, we got a new bad boy on the scene, and it's an unlikely candidate, the superannuation sector. Joe Longo, the chairman of the Australian Securities and Investments Commission, so the corporate cop in Australia, declared that the super industry was currently the poster child for poor governance in Australia. James, I thought everyone loved the super funds. What's going on here?
Well, ASIC has cracked it, basically. It's had enough of these super funds who sort of like to hold themselves out as a bit of a successful cottage industry, the nice guy of financial services, just doing the right thing, protecting your savings. That's true, but I think the sector has got so big, it's now worth $4.2 trillion, that ASIC wants to make sure these guys are doing the right thing. And where the super funds are falling down at the moment is what you might call members' services. So ASIC's run a number of court cases now against the likes of Australian Super and CBUS over death benefits. So when the super account holder dies, their super savings get passed on to someone. The super funds have really struggled to process those death benefits. They can be tricky and complex matters too, to be fair. But a lot of this administrative burden has been outsourced to a third party. It's called MUFG. It's a big Japanese company. It used to be known here in Australia as Link. And Link had some problems during the COVID period with staffing. A big backlog of claims opened up. And basically ASIC's looking at this and saying to the super funds, hey, you can't just blame Link. You're responsible for this. You decided to outsource all this stuff. You need to get on top of it. What Joe Longo's saying is this has to be sheeted home to the boards of these super funds. They can't just sit around and saying, throw their hands up and say, well, woe is us. It's not our fault. It's an industry-wide problem. The super fund boards are responsible for sorting this out. And I think he's tried to put a rocket up the super fund boards. Do we really think that they're the poster child for poor governance in Australia? I'm not sure. I would have thought WiseTech and Mineral Resources might take that, or even Star, as we've just been talking about. But I think ASIC is trying to send a message to the super funds. And that message is, you're in our sights now. You're big, you're ugly, you need to be ready for more scrutiny. Now, I should say, Anthony, the super funds didn't love this line from Joe Longo's speech. One of the lobby groups came out and said it was unfair and uncalled for. But I think the industry just needs to get used to scrutiny ratcheting up. I can't see any other way. It's a big sector. It's systemically important, and with that is going to come systemic scrutiny.
100%, James. I mean, more than 16 million members. I mean, every Australian worker's got a superannuation account now. Like we know the banks cop it over mortgages and everything, but like 1 in 3 households has a mortgage. Nearly everyone has super. So it's the way the world's going. And can I just say, James, firstly, this one sucks. Like death benefits. Imagine being in that position where you lost a loved one or you got a terminal diagnosis or whatever, and you get mucked around on that because of some processing issues.
Yes.
I mean, at the core of it doesn't pass any tests, just blaming a service provider for that. But secondly, can I also say, James, it's good to see the regulator going after a big dog in an industry. I mean, for the past year or two, it feels like regulators have beaten up on those already on the back foot. ACCC went after Qantas. ACCC went after the supermarkets when they were already the public enemy number one. APRA went after ANZ when it was on its knees with the markets scandal. Now, I get that regulators often, have to go after these softer targets. I mean, that's their job, but it's good to see them going after one of the big guys. And I mean, if they're keeping Australian super honest and trying to keep them honest, then surely everyone's going to pay attention to that.
Yeah, no, fair point. This will reverberate around the sector.
Okay, James, listeners might remember that on our last episode, you declared that Donald Trump's big policy shifts had changed the game for investors. Well, this week we learned just how dramatic that change actually is. Share markets on Wall Street plunged on Monday night as investors became increasingly concerned that the combination of Trump's tariffs and spending cuts could push the US economy into recession. Now, that led to a wave of selling on the ASX, which is flirting with what's called a correction, and that's when the market falls 10% or more from its recent peak, which came on February 14 in Australia and February 13 in the US. Now, James, there's a lot going on here. You've been writing about markets all week. There's huge reader interest in it. So let's just break it down a little bit for listeners with a bit of a question and answer session. And let's start with the obvious one. James, is this drama all about Trump?
Well, it feels like that. I mean, Trump sort of casts such a long orange shadow over everything that it can feel like everything in the world has got to do with Trump at the moment. But I think starting points matter. So think back to the start of this year. It feels like it was a long time ago. It's only a couple of months. We came into 2025 in both Australia and the US with share market valuations very elevated and share markets hit record highs in February. So investors were very bullish about the future in both Australia and America, particularly in America, where we as we've said a lot, we've crowded into these 7 tech stocks, the Magnificent Seven, and we've really made investing all about them. And look, you got to say they've stood up pretty magnificently during that period and driven a 70% gain on Wall Street in the last 2 and a bit years. But the problem is everything was priced for perfection, and all we've seen this year is disappointment. So first we had DeepSeek, the Chinese AI model, emerge and really rock everyone's confidence in this AI revolution story. Then we had a pretty crappy earnings season in Australia particularly, where there were only slightly more beats than misses and earnings outlooks were downgraded. And we had a bit of a tepid earnings season in the US, where again, earnings outlooks for the 2025 year were also downgraded. And then we've got Trump. So Trump comes in with this incredibly chaotic legislative agenda. There's policy changes everywhere. There's tariffs being levied and then taken off within the space of a couple of hours on some nights. And this uncertainty has just hit markets. But it's not all about Trump. There was a weakening of the sentiment around markets before Trump, and he's sort of just exaggerated everything with this chaos that he's unleashed.
Yeah, well put. I mean, I agree with you. It's become about Trump, hasn't it? But the seeds of the discontent, they stretch back 5 years. It's that COVID era, this COVID era stimulus that followed it, the supply chain disruptions, the inflation, the interest rate hikes, security concerns, all that gets Trump elected. Markets at high, like you say, for no real reason other than 7 stocks, tech stocks that are growing like weeds. And then all of a sudden you just got these conditions that are just ripe for a week like this. Now, James, at the heart of this week, everyone's now talking about fears of a US recession. Do you think they're actually real?
No. I think the fears are real, but I think the chance of a US recession is actually pretty limited. For example, we saw Goldman Sachs. They cut their outlook for the US economy for GDP growth in 2025. But it went from 2.4%, which is pretty solid, to 1.7%. Now, that's not recession territory. So the idea that we're about to head into a US recession that'll reverberate around the world, that's not quite right. But there is a growth scare because Trump is determined to drive change. As we said last week, he wants to get the US budget deficit down from 7% of GDP down to about 3% of GDP. To do that, he needs to find a lot of savings everywhere. And look at how many places he's looking. He's trying to get Elon Musk's Doge, Department of Government Efficiency, to find savings. He's trying to change America's stance in terms of its security obligations to the rest of the world. And that's a way to cut defense spending. And he's trying to impose these tariffs to improve revenue in America. So if you can bring manufacturing back to America, that's the idea here, those companies drive economic growth and they pay more tax and everybody wins. That's the theory anyway. So the change he's trying to drive is very real, and it does threaten growth. Tariffs do weigh on economic growth and they do push up inflation. And that's this idea, Anthony, called stagflation. Sort of like the worst of both worlds, where you've got growth coming off, but inflation is still pretty sticky. And that means central banks find it harder to cut rates and give the economy some support. So no, we're not going to have a recession, but yes, there is a real growth scare. And this idea of stagflation is a big part of it. And we haven't seen a sort of real stagflationary period since the 1970s, which is, of course, before both of us were on this earth, Anthony, and won't be a part of the thinking of many consumers around the world either. Now, Anthony, we always say the US sneezes and then Australia catches a cold. Does that explain why the ASX has fallen so hard in such a short space of time?
In a nutshell, yes. I mean, like, we can sit here and say earnings this, multiples that, valuations are stretched, all that stuff. At the end of the day, James, these big moves, like this nearly 10% slide in the ASX 200, that's a liquidity game. That's when the big real money investors, your sovereign wealth funds, your super funds, they're pulling back some of their equity bets. And on Wednesday, which was our big down day, I mean, we could have had Commonwealth Bank, BHP, Macquarie, and Telstra all do earnings upgrades on that day, and we still would have finished in the red. You know, that's just, it's just like shows you, it's just the weight of money in the market. When sentiment changes, people are retreating. That's the tide that we're swimming in here, James. And it's all about the US. It's about what's going on over there. It's the tariffs, the recession fears, all that stuff you've just finished talking about. Now, James, what doesn't help though is in Australia, we have a market at an all-time high. You know, in February, we had it bid up for basically no reason other than those same real money investors decided that public equities were going great and they needed to put their money somewhere, and they were putting it into large cap stocks in the US, large cap stocks here, and the market goes up. I mean, that just pushes up share prices. Earnings hadn't really kept up. We've had earnings have gone backwards at an aggregate level on the Australian market for the past 3 years, James. Right? So we've got shares at all-time high. Earnings have been going backwards. Obviously, that doesn't just stack up. So then you add Trump, you get the sell-off in the US, you get the tariffs here, James. I mean, don't forget those steel and aluminium tariffs, as puny as they might be, but just the sentiment around it. Throw in all that, you get a good point. You get a good old sell-off. And that's what it was like in the middle of this week. And the question is, James, like, was it just blowing off a bit of steam, or is there more coming? And I reckon you could see the market sell off another 10%, and some investors would still say it's too expensive. You know, that's just kind of the conditions we're in at the moment. Yeah,
a good point. I mean, Anthony, we're talking a lot here about public equities, public equity markets, but we've been rabbiting on this podcast for 2 years about how important private markets are, so private equity and private credit. What's happening there? Are we seeing much movement there? You've spoken to a few bigwigs from the private equity sector in the last week or so. Any sense that they're getting worried about their lot in life?
Well, I can assure you, James, it certainly hasn't slowed down the salesmen and the saleswomen from wanting to sell it. I mean, like you say, the private equity guys, men and women, they're coming to Australia, I think, in record numbers, trying to get more of that $4.2 trillion in superannuation money, as you said. Yep. Although after this week, it might not be worth $4.2 trillion anymore. But they're all here in Australia. One of them I met this week was EQT Asia's boss, Jean Salata, who is the most successful private equity investor in Asia. Wow. He's done very well for himself, worth squillions. Anyway, what he was telling me that I was surprised about, James, is he loves Australian software companies. His firm has bought 3 in the past year.
Yeah, okay.
They bought a 4th to whack into another portfolio the company they have, and they're studying a 5th one at the moment, James. A 5th in 12 months. So
wow,
I don't appreciate that. So anyway, but what we've seen around these private equity and private credit firms, James, and we've seen this in the not too distant past, and I expect it'll play out now as well. But in times of public market volatility, when share prices are really roaring up or roaring down, these private market assets are not revalued in the same way as the public markets, nowhere near as aggressively. So when the market's tanking like it has been, you know, I suspect our private equity mates will assure investors that they have independent valuers working on this, but the value of their companies won't come off as much. And the same when markets roar on the upside, they don't go up as much either, which provides for a bit of a smoother sort of ride for the underlying investors who, you know, there are superannuation funds and sovereign wealth funds and all sort of that. So, James, I'm a big public markets advocate, as you know, but these private markets, they, you know, we can't ignore them at all. They're becoming more and more important. Australian super funds piling into them. They're going to keep piling more money into them. That's just where the stage of their growth is at the moment. James, towards the end of this week, the market sort of steadied down a bit, but everyone's still looking over their shoulder. All right. So what should we watch out for next? Like, what's the big moment that might be out there?
Well, Anthony, markets love labels. They love to have a catchphrase, a bit of jargon for things. So when markets are falling, there's two bits of jargon we like to throw around. The first is a correction, which is, as we said before, it's when the market's fallen 10% from its most recent peak or a bit more. So correction's pretty bad, uncomfortable, nothing to write home about. But a bear market, that's when the market's fallen 20% from its recent peak. And a bear sounds a lot scarier than a correction, right? So that's what you're watching for next, I think. Now, lots of people say, look, these bits of jargon, these labels, these round numbers, they don't matter. They're just figures, right? But I reckon they do matter because they get written up in the media and that infects sentiment. And when people feel less wealthy, they go out and spend less. So that's what I'd be watching for. Does this correction turn into a bear market? The other thing to watch, this is what the professionals will tell you, is something called credit spreads. Mm-hmm. So this is a bit technical, but it's the amount that a company or an organisation or institution pays above the official interest rate to borrow money. So let's say the official interest rate, I'm picking a number, is 5%. If the credit spread might be 2% on top of that, and so that means the borrower is paying 7%. Credit spreads have been very tight, and so that suggests that the credit market's fairly relaxed about what they're seeing. If we were to see a blowout in credit spreads, if they were to widen further, that would be something that would really put the frighteners through the markets. But it's really important to note, one good thing of this period is that we haven't seen very much movement in credit spreads at all, which has a lot of people saying, look, don't worry about it. This is just flaky, overheated equity markets selling off, blowing off a bit of steam. The credit markets are the real boss of the world, and watch those. So it's just something to keep an eye on. But Anthony, the other thing I'm keeping an eye on is Trump. Mm-hmm. We've been told that he follows the stock market really closely and sees it as a marker of success. Do you think he'll hold his nerve as the market keeps falling? Or do you think he'll sort of crack and say, no, we do love growth, we do love the market?
Well, it's only early days for Trump, James. He has 4 years, and I reckon he's been pretty calculated in what he's doing. He's a long-time advocate of tariffs. He's been rolling them out pretty methodically to address the US trade deficit and strategic reasons, particularly pushing everyone on defence spending now. I reckon he's in office for 4 years. He's willing to inflict a bit of pain on the economy, on markets in the short term. I mean, does he want to be the person that tanked the market? Like, of course not. But he does want to be the person that, ends Russia's invasion of Ukraine, that stops fighting in the Gaza, the guy that got the Western world to double or triple its defense spending and sort of decrease that security reliance on the US. I mean, I think he will stay the course with what he's doing. I mean, like I said, he's got 4 years. He's not getting turfed out early. He doesn't have to worry about re-election. Is that what you mean by holding his nerve, though, James? I'm not sure. Like, this is Donald Trump. Yeah. He's keeping the rest of the world nervous. But I think he'll keep going.
Yeah, I agree. I think this is a carefully formulated plan. He's 7 or 8 weeks in. I think he wants to see this through. I think they have big plans to change America, and whether you like it or not, I think investors are waking up that this isn't just a bluff or a negotiating tactics or noise for the sake of noise. There's something bigger happening here, and that's really going to change markets. Well, Anthony, that's been a very solid and serious hit out on markets. So let's give listeners something a little bit different and head to the track, the racetrack. It's Formula One week down here in Victoria, and the rockstar drivers, the huge teams and the celebrities have all flown in for what's become one of the biggest events on Australian sporting calendar. Now, Anthony, this event is supposed to be worth a few $100 million a year to Victoria's economy, at a time when I'm sad to say we do need a bit of a kick along down here. Reports suggest it costs the state about $100 million a year to put on. And that's money, of course, that comes out of taxpayers' pockets. So, Anthony, is hosting an event like this good business or bad for the state?
Well, first of all, James, let me say thank you to yourself and all the other Victorians for sponsoring an event like this, putting it on, making Australia look good. Melbourne does these events fantastically well, really is the home of sport in Australia. And it sounds like everyone's getting around the Formula One this weekend. So
bigger than Ben-Hur,
bigger than Ben-Hur. I think so. It costs the government quite a bit of money to put it on. Apparently, that's going to do well for the Victorian economy. And no offence, you guys do need the help. So but the glow on Australia more broadly, I mean, we're all going to benefit from that. So thanks, James. But basically, no, I think it's good putting on for sure. For me, this is an investment. We shouldn't shy away from things like this. It's important to keep Australia on the world stage and put our hand up for great events that people are actually interested in. And if you look at the crowd numbers this weekend, people are interested.
Yeah, they're going to hit records, I think, even with what's predicted to be quite a wet day on Sunday. But Anthony, I think what people might not understand is just how big a business Formula One is. Can you talk us through the competition and how it all actually works?
James, it is so different to Australian sports, which tend to be owned by member-based clubs or sometimes privately owned clubs, but the leagues themselves are sort of owned by the clubs and they're the ones that control the sport. Like Formula One is a company. It's a holding company controlled by John Malone's Liberty Media, which is a big US company. They acquired Formula One for US $8 billion in 2017 from a private equity firm.
Right.
So the Formula One, the holding company, it's based in London and it's essentially just a commercial rights and licensing organisation. It's got less than 1,000 employees, which is nothing, right? The big Formula One teams themselves, they've all got more than that. Now, Formula One makes money in three main ways, James. It sells broadcasting rights, it signs advertising and sponsorship deals, and then it gets promotional fees paid by people like yourself and your fellow Victorians to actually host a race. So Formula One, the holding company, James, it's listed on the share market. It has a US $26 billion market capitalization. You know, that's $40 billion plus in Aussie dollar terms. So it's big, right? Now, in the year just gone, Formula One Group recorded $3.6 billion US in revenue, $500 million operating profit. Revenue was up 6% last year, operating profit up 26%. So it's going in the right direction. Like investors obviously like it at the moment. The shares were at an all-time high just recently. They look at this as like a asset-light business model, virtually no capital expenditure, pays next to no taxes because it's got a bucket load of operating losses from over the years, but basically just organises races. It doesn't own cars or teams or even employ that many people. James, it just organises 24 races a year, sells all the sponsorship around it. The value's in the brand. Like that's the attraction of the sport, right? 6.5 million people, I reckon, went to a Formula One race last year.
How have the shares been going?
And the shares been going really well until the recent market sell-off.
Right.
The thing that's really been driving the past couple of years is cracking the US market. It's now got 3 races in the US, Miami, Vegas, and I think the third one's in Austin.
Austin.
Yeah. So it's growing that US audience, increasing engagement. That gets the big US companies sponsoring it. And if you just have a look at their sponsors, James, they're very, very different names to what you'd get for the AFL or the NRL or any Australian sport. You've got like these huge global companies, Aramco, Amazon's AWS, DHL, Heineken, LVMH. So these are like the biggest companies in the world. But James, a really big thing for cracking the US though, and I think what's delivering a lot of this momentum comes down to this Drive to Survive reality TV show or documentary, right? Into its 7th season. What's that done for the sport and its sort of place in people's minds?
Well, I think it's just been incredibly important to opening up new audiences. You know, I went to the Formula One's been here for a long time. You know, I've went to some of the early races in Australia. It was a fairly blokey petrol head type atmosphere, right? You go now, it's people of all generations, all genders, all sorts of backgrounds. It's a bit like a mix between, I don't know, the spring racing carnival and the AFL finals or the NRL finals. You got lots of hospitality, lots of people from all different backgrounds, quite a glamorous high-end feel to the thing. And I think Drive to Survive's been really important to that. I mean, Formula One is both a simple sport and a really complex sport, right? So 20 drivers zoom around the track, one wins, end of story. But what Drive to Survive's made clear is there's lots of intrigue inside that sport. So, you've got the people competing for 5th and 6th, for example, are actually really important because there's massive amounts of money at stake, prize money at stake for those positions on the league tables at the end of the season. And the other thing it's done, it's created characters. It makes the drivers and even the team managers and the engineers that these, people you never would have come across, it makes them into real characters and helps you identify with them. And I think the other thing is that it demystifies a pretty technical sport. So, everyone who's watched a couple of episodes of Drive to Survive can now watch a Formula One race, and when they're talking about tyre temperatures and the track conditions and, what the driver's trying to achieve, you can go, oh, yeah, I know all about that. Yeah, hard tyres, soft tyres, medium compound, I'm all across that. So I think we've seen copycat documentaries in lots of sports. There's a great one about golf called Full Swing. I think there's NRL and AFL documentaries in the Drive to Survive style that are being produced this season. So it is a real game changer. But it just makes me ask a really important question, Anthony. Is this a sport or is it a business or is there a way you can have both?
Good question, James. Very high level. In my mind, this is a business.
Yeah.
All right. You don't go down for a walk on a Saturday afternoon and see kids at the park practicing their Formula One racing. So, I don't know, James. I look at this like a business, and everything you say about the way it's teed up around the events, the documentary, the sponsorship dollars, driving this revenue listed company, in my mind, it's a business from what started as a sport. What do you think?
I think that's a good description. I think if it is a business, it's a really fun one, but the way they've monetized this sport is just extraordinary. And, you'll see some, if you watch the race on Saturday, you'll see a shot of the driver in their cockpit. Count the number of sponsorship advertisements around them and you'll get an idea whether this is a sport or a business, I reckon. But final thing, Anthony, we got 2 Australians in the race this year, Oscar Piastri and Jack Doohan. So there's a little bit of extra spice for the Australian race, and I think that's the other good thing about Formula One. It's an international sport, and that just broadens the audience and the customer base even further. It's pretty impressive.
Yeah, surely with 2 drivers, we're punching above our weight too,
Yeah,
James.
Good point. Well, let's see how they go on Sunday. All right, we'll come back after the break. Some crucial economic data and a big event on the AFR calendar next week. Back in a sec. Well, welcome back. If you want to know more about what we're talking about today and a whole lot more, AFR subscribers can sign up to the Chanticleer newsletter at join.afr.com/Chanticleer. Every Saturday morning, the newsletter pulls together the best Chanticleer columns from the week and delivers them straight to your inbox. Okay, Anthony, really big day on the AFR calendar on Tuesday for the annual banking summit up in Sydney. We've got the head of APRA, got someone from the RBA, we've got most of the big 4 banks represented in some way. And, of course, the ASX sell-off has really been centred around the banking sector. I think shares in Commonwealth Bank are off about 12%.
Wow.
Most of the other banks are off similar, except for NAB, which is off almost 20%. So good time to have a banking summit, right?
Always a good time to have a banking summit. And no doubt we'll be hearing a lot of stories, James, about what it's like in Queensland and northern New South Wales. These banks, they've been sending their executives up there just to meet with customers, and hopefully they come back with some good things to say.
Yeah, good point. Saturday morning our time, there's an important bit of US data. That's consumer confidence. I wonder how people are feeling with all this noise on the share market and all this noise around tariffs. Could be a really interesting reading. And then next Thursday, we get a really important bit of Australian data. That's employment. So how's the job market's going? Where's the unemployment rate? This is really crucial to the RBA now, isn't it, Anthony?
It sure is, James. And like when we were talking earlier about the moments that could be out there, I mean, for Australia, it's still around that sort of inflation and the economy and whether things pick up again. And, the jobs market is obviously a huge part of that.
Yeah, all about employment. All right, we'll have questions here on the Chanticleer podcast, and this week our question is from David Owen in New South Wales. If you've got a question you want to send in, you can email us at chanticleer@afr.com. You can also send us a question in audio form. Just record a voice memo on your phone, include your name and where you're from, and email it to us. So David asks, "Hello, Chooks. Great podcast, which I listen to every week. I was just reading Tony Davis's excellent article in the Fin Review on Tesla's sales drop and thinking the company appears to be suffering from a similar founder's syndrome as WiseTech or Mineral Resources, where a visionary founder or CEO of a listed company is demonstrating questionable behaviours. In this instance, Tesla sales are now dropping around the world and potential buyers are often citing Musk's behaviour and opinions as the reason for avoiding the car. Given Musk only owns 12% of Tesla stock, isn't there a governance question here? I note the chairman, who's an Australian called Robin Denholm, and the board has been pretty silent on the CEO's divisive behaviour and all his time spent on external interests." This is a really fascinating question, Anthony. Tesla shares have been walloped in the last month. Where do you sit on this one? Is this a bit of founder syndrome, as David suggests?
100%. David is hit the nail on the head. It's just that Elon Musk has done such a good job in creating this company and making money for people along the way that, you know, everyone's forgiving, and he's so important to it, the vision, all that sort of stuff. But James, I don't think you'd see, you know, BHP's boss or Commonwealth Bank of Australia's boss so hooked in with government, spending so much time on other things and getting away with it. So, yeah, sure, it's definitely a situation that's unique to a founder-run company. And James, we've been seeing this sort of stuff from Musk. I mean, like Trump's just the latest bit, right? We've seen it consistently over the years, these sorts of things.
Musk is definitely a divisive figure, and no doubt about that. I mean, there's a lot of people who agree with the principle of Doge, of trying to reduce government spending, but the way he does it and his, I guess, aggression on social media particularly can be a bit confronting at times. I think there's a few other things going on at Tesla, though, that are worth mentioning.
Yep.
The tariffs that Musk's mate Donald Trump is bringing in aren't really helpful for Tesla, and in fact, they warned on Thursday night that there's going to be a hit from reciprocal tariffs. That's one thing. The other thing is Tesla's key models are getting long in the tooth. You know, car companies thrive by releasing new models regularly. Tesla hasn't been doing that. And, you know, Elon Musk talks a big game about full self-driving and autonomous vehicles and robo-taxis. None of it seems to arrive very quickly. So I think there's a bit of skepticism around the company because of that. The other problem Elon Musk has got is China. The Chinese have just come out of the clouds to dominate the electric vehicle market. They are pumping out so many cars, much cheaper than, in many cases, than Tesla models. And it's really serious, stiff competition. I'm not sure about you, Anthony, but the amount of BYD vehicles you notice around the streets of Australia, I think, you know, it's really anecdotal evidence. But it does signify a bit of a change in what people are prepared to look at. So there's a few clouds hanging over Tesla, and it's a time, Anthony, when I reckon you'd want your CEO fully focused on the company. And this guy could not have more irons in the fire. So fascinating one to watch.
Yeah, Musk's always got a lot on his plate. This is just the latest.
All right, Anthony, another big week. We'll see where markets go on Friday night in the US. It's often you get a tough night in the US and that spills over and sets the tone for the next week. So we'll see how that ends up. And I'll look forward to seeing you for the Banking Summit next week.
Yep, see you at the Banking Summit, James.
Thanks for listening. We'll see you next week. If you like the podcast and you want to hear more, consider sharing or giving the podcast a review, as it helps other listeners find us. And don't forget to follow wherever you get your podcasts. At the Financial Review, we investigate the big stories about markets, business and power. For more, go to afr.com. You can subscribe to the Financial Review, the daily habit of successful people, at afr.com/subscribe. Chanticleer was hosted by me, James Thompson and Anthony McDonald, and it was produced by Alex Gow and Lapfan. Our theme is by Alex Gow, head of podcast is Lapfan, and the head of premium content is Fiona Buffini.
The Australian Financial Review.